So when most people hear the words real estate investing, their brain usually goes straight to becoming a landlord, like tenants, toilets, 2 a.m. maintenance calls. That is not what the wealthiest real estate investors in this country are doing. There's actually a structure that lets you own a piece of a 200, 300 unit apartment building, collect quarterly income from it, never have to manage a single tenant, never have to sign on a single loan. Now, this structure's been around for decades. Institutions use it all the time to compound wealth in real estate, and they have for the last 40 years. But most individual investors, they just never got the memo. So today I want to cover what that structure actually is, why it exists, and exactly how the money flows. So here's what nobody tells you about multifamily investing at scale. The barrier is not money. The barrier is the structure. See, Class A multifamily property, say 200 units or more, depending on the market, runs anywhere from, say, $20 million to $80 million. Nobody buys that alone. It's not John and Jim putting their piggy bank together to buy that. Institutional capital's poured over $300 billion into multifamily real estate just in the last decade. Pension funds and family offices and endowments, they've all been quietly compounding in this asset class while most individual investors stayed completely on the sidelines. And the ones that did try to get into real estate, well, they bought a duplex, maybe a small apartment building or an Airbnb. They became the operator, and they discovered pretty darn quickly that owning property and passively investing in real estate are two totally different things. Now, the vehicle that bridges the gap is called a real estate syndication. And the concept of it is a lot more simple than the jargon makes it sound. It's basically this. You bring capital, and a professional operator finds the deal, negotiates the purchase, secures the debt, hires the property management company, and executes the business plan. You collect income and they do the work. That's it. A very clean division of labor. And once you see the distinction between that and being a landlord, you can't unsee it. Now, let me break down exactly how this works, because a lot of the terminology sounds a lot more complicated than it really is. There are two roles in a syndication: the general partner and the limited partner. Now, the general partner, or the GP, is the operator. They're the one that finds the deal, negotiates it, secures the financing and the debt, builds out the business plan, and manages the asset from acquisition all the way through to an eventual sale or exit. They put in the work, and they put in a small slice of the equity, usually 5 to 10% maybe of the capital stack. And then you, as the limited partner, the LP, you fund the majority of the equity alongside of other LPs, and you get a preferred return on your capital and a percentage of the ongoing cash flow. And you also get to share the back-end profit when the asset sells. The really cool thing here is that your liability is capped at your investment. You don't sign on the loan, you don't field maintenance calls. You are a truly passive participant in a professionally run asset. That GP-LP split is the entire engine. The GP provides institutional level operations, and the LP provides the capital. And the reason that this vehicle exists is because running a 250 unit apartment building and doing it well is a full-time professional operation. It requires systems and relationships and a lot of experience that most individual everyday investors don't have, and they shouldn't have to build from scratch. And here's the part, though, that frustrates me the most about the conversation around syndications. There are approximately 13 million accredited investor households in the United States, and fewer than 3% of them actively participate in private placements or real estate syndications. And the number one reason that people give when you ask them why is they didn't know where to find them, or they didn't know they existed. That is not a coincidence. That is a structural problem, and I call it the advisor gap. See, your CPA is not going to bring you a syndication deal. It's not their job. Your financial advisor, they're registered to sell securities, and most syndications are Reg D private offerings that sit completely outside of their product shelf. So it's not that they're hiding it from you, it's that it literally does not exist inside of their toolkit and what they're able to offer you. So unless you're in the right rooms, talking to the right people, having the right conversations, you simply never see these deals. And so you keep just putting capital into public markets and mutual funds and REITs, wondering why everything moves together every time the Fed opens its mouth. And that's the gap. It's exactly why we're having this conversation. So now you know what a multifamily syndication is at a high level, why the structure exists, and why most accredited investors have never been offered one. And part 2 of this, we're going to get into the math, what the actual return structure looks like, the tax layer that most people completely miss, and how to know if you qualify and exactly how to vet a deal before you write a check. So that's up next. Hit the subscribe button so you don't miss it. And if you want to go ahead and get into the numbers right now, part 2 is right here.